Gillian, thank you very much indeed. For the final speaker with prepared remarks, I'd like to turn to Ebrahim Rakbari of Citi, who is in fact the second person on the stage here to have invented a famous acronym, or claims to be, perhaps not as attractive in sounding as the BRICS acronym that Jim O'Neill came up with. Ebrahim tells me he came up with Grexit, which is something which we've been hearing a lot about in recent weeks. Perhaps you could give us a slightly broader view of how you expect the Eurozone situation to play out in the next few weeks, what the possible scenarios are, and what are the trigger points and key events we should be looking out for.
Thank you very much, Neil, and thanks all for having me today. It's a great pleasure to be here. Now, as Neil said at the outset, we are proceeding somewhat in the order of gloominess to some extent. So in Europe, we're looking clearly at a crisis trajectory, and I guess the sobering news is it is only going to get worse from here. In terms of the ramifications for Central and Eastern Europe, as Caroline pointed out, even there, narrowly thinking about these three possible channels, sort of a trade and activity channel, a banking channel, and a portfolio and capital flow channel, which is very closely tied to uncertainty or risk aversion. Again, on all three of these, the further evolution of the euro area crisis is likely to move in the direction of a further escalation or a further intensification of these pressures, meaning that Eastern Europe will need all the resilience it has, or all the resilience it may be able to build up over the months and years to come. Now, when we look at the very acute question of interest, which is of course whether Greece will be able to do just about enough to allow it to stay in the Eurozone, we should be quite frank. I mean, Greece may exit, it may exit quite soon, or it may not. There is really very little at this point that moves the needle decisively in terms of being able to project this outcome with any type of decisiveness. It is a question of political decisions within Greece, first and foremost. There is no question that the Europeans as such would be more than willing to be somewhat accommodative to allow Greece to stay. But there may come a stage at a point in time when the population will no longer believe in the direction that it's been pointed towards by leaders that have lost all credibility, and that primarily means domestically, but to some extent, of course, points to the European leadership as well. Now, more broadly thinking about this acute crisis situation, there are really three potential outcomes. There is a decisive resolution. This is a decisive resolution relative to the uncertainty in Greece, but it also applies more broadly about the euro area crisis. There is the second option, which is some type of a collapse, a sort of an Argentina-like scenario for Greece, or more fundamentally a breakup of the Eurozone as a whole. And the third is that ugly other word that we've been hearing over and over again, which is some type of a muddling through scenario. And if we want to put probabilities on these, if it comes to the Greek outcome or for the euro area crisis as a whole, then it is pretty clear that that first option, a decisive solution, a re-establishment, if you want, of a sustainable growth situation for Greece or for the euro area as a whole, is really a near zero probability event. What it would require in Greece and elsewhere would be a restructuring of excessive levels of debt, very often in the private sector, and quite frequently also in the public sector. Again, in Greece, this is a fairly obvious point, but it applies more broadly to many areas in Europe, including in the banking sector, some which are not exactly at the forefront of crisis concerns today. It is worth pointing out, when it comes to Europe, not just Greece, that we are not even talking about a true resolution of the crisis. A true resolution, as I said, requires almost wholesale restructuring of debt. Even the things that we are discussing at the policy level, Eurobonds or a European deposit guarantee scheme, if you want, are no such thing. There are only step points that could possibly buy us the time to to come to terms with the underlying challenges of excessive levels of debt, which are in turn tied to some of the things that Jim was discussing earlier on, structural issues, competitiveness issues, that are in some ways reminiscent of challenges that this region has faced in prior decades. Now, if we think that this decisive solution isn't one that we are likely to see, that still doesn't mean that there is a direct linkage to the opposite extreme, which is a collapse or a breakup of the Eurozone. Primarily with respect to the Greek situation, that doesn't mean that even if Greek exits, we necessarily will see a further sequence of exits by other euro area countries. And there, what comes to bear are both the ability and the willingness of European policymakers to move. When it comes to the willingness, I sometimes call it the 3 Ps of the European project, which are peace, power, and prosperity. And these 3 were really the backbone of the European project. And even though peace is maybe slightly less important in this pecking order, all 3 still maintain a strong relevance for the European policymakers and will determine that ultimately the willingness is there to keep the European project alive, and the European project these days is intimately linked to the future of the euro area for the time being. Now, in addition to that, you need to have the willingness. There's a presentation that I sometimes give which somehow provocatively asks, is the euro area a new emerging market without growth? And there are many analogies, including very pro-cyclical monetary and fiscal policy, to a certain extent. There is one big difference, which is that the ability to prevent a collapse in outcomes is there. And that's to a smaller extent because, as Jim pointed out, debt and deficits level in the euro area are not outrageous compared to other advanced economies. But it also has very much to do with the fact that ultimately, at least from a currency perspective, the liabilities of the euro area are predominantly euro denominated. They're predominantly domestic when it comes to the euro area as a whole, which means that when it comes to addressing contagion outcomes, non-fundamental crisis concerns, there is an institution with almost unlimited pockets, technically unlimited pockets in nominal terms, which is the ECB, which would be able to prevent a wholesale collapse if some degree of policy consensus is there. Now, what that means for us, and we as a house do think that Greece is more likely than not to exit the euro area. And the question for us is more, is this an outcome which is more likely to happen before the end of the year or sometimes in 2013? That we would very likely see a graduated policy response, which would not involve any of the measures we see in a front-loaded manner, any of the measures we discuss at the European policy level in a front-loaded manner. No Eurobonds, no deposit guarantee scheme wholesale, for technical and for fundamental reasons. But that would involve, in a microscopic fashion, the approach that European policymakers have espoused all the way to date in the euro area crisis, which is a heavy reliance on the central bank in the immediate crisis mitigation period. So liquidity, heavy reliance on liquidity injections, and further promises and rhetoric towards some type of further integration in the future, which would involve a gradual way to deal with the fundamental issues which are in the areas of, again, structural reform, banking sector debt, and banking sector debt both by way of restructuring and by way of gradual deleveraging. And that will end up being, I think, in some sense, hopefully, a warning to Eastern Europe that it needs to, for Central and Eastern Europe, that it will need to continue the path of reform, and it needs to be very wary of letting up in the light of challenges that may well pose themselves with greater urgency in years to come. But conversely, there may well be a cue, as was just implied by some of the previous speakers, for the Europeans that they should not let this crisis go to waste, and that we will see, in not quite as an accelerated fashion as in some of the other examples, but we will see a continuation of the structural reform measures that we are seeing in places like Portugal and Ireland most prominently, but also in Spain and Greece and to some extent Italy. And we will see these to be continued, and that these will ultimately put us in a position in many years to come, which despite a very unexciting growth period in between, will make us somewhat more hopeful. And maybe one of those days we can have a conference just like this one, where we can look back at the challenges in the past and say that we came through this okay in the end.
Ibrahim, thanks very much for ending on an optimistic note. We still have some time for discussion, and I'd like to encourage the panelists to jump in when they have points to make on these issues, and to Jim as well, who's kindly joined us. I'd like to return to the title of the discussion and put the question to you: are there opportunities for Central and Eastern European countries, particularly for Poland, but also for others? Are there opportunities, are there benefits that Poland and the rest of the region could actually gain from the current situation? In a sense, Poland already has. It's outstripped everyone else's growth rate, so it's become a bigger part of the European economy proportionally than it was some years ago. But are there other ways in which it could benefit? Is there anyone who'd like to start on that? Simon first, or Simon first? And
okay, fine. I mean, Poland has already benefited greatly. Romania has actually done pretty well. Czech has done very well. Czech Republic. All three countries have issued already more than 60% of planned bond issuances for this year on the domestic and also on the Eurobond side, which shows essentially that the investor community is actually already moving towards emerging Europe. And if you look at the G7 outstanding nominal government debt, we're talking about $40 trillion. And if you look at emerging markets, it's about $8.5 to $9 trillion. There are already at top management levels in asset allocations, in pension funds, global pension funds, Western European pension funds, which are looking to move some of the, or reallocate some of the assets from G7, from DM markets into emerging markets. And I think this is where the region in particular has something to play very strongly.
Benoit, would you like to add to that?
I really believe in inflection points in markets, and we are really reaching boiling points now, so something needs to happen pretty soon, otherwise it's going to be a total meltdown in Europe, and with massive consequences on the region. So against this backdrop, one country I have in my radar is actually Hungary, because Hungary is on the brink of a massive crisis, and nothing happens, that country is going to go through a massive disaster and financial crisis. But at the same time, exactly the same way the trajectory right now for the Eurozone is not necessarily positive, I believe perhaps in a last-minute policy signal, and I hope that's going to happen for Hungary, and maybe down the road this is going to be a fantastic opportunity. There's going to be a lot of stress along the way. It's a bumpy road to a massive risk rally, but the levels or the cheapness of the assets over there is going to be a compelling case. I'm thinking about the fixed income market in particular. So that's a country to look at with the hope that we're going to get a very strong policy signals. In the meantime, let's continue to be extremely bearish tactically.